I'm not aware of many, if any, sovereign investors, for example, that have invested in Bitcoin. So they're not necessarily trendsetters, but very methodical, very sophisticated investors, and able to take that illiquidity premium and try out small pieces of new areas in the market.
Die Geldmeisterin. Der Finanzpodcast mit Julia Kistner. Our guest on Geldmeisterin today is Rod Ringrow, Head of Official Institutions at Invesco. We'll be delving into the world of sovereign investors and discussing their impact on global markets. Sovereign investors are government-owned investment funds with massive financial resources, as you know. Countries like Norway or Singapore, backed by oil wealth or strong economies, are prime examples. These funds, filled with cash from resource exports or trade surpluses, aim to secure the financial future of their nations. Beyond wealth accumulation, sovereign investors are becoming powerful forces for global change. By investing billions in developing countries' infrastructure, education, healthcare, and the transition to clean energy. However, critics point to potential risks such as geopolitical interference and greenwashing. Ultimately, the impact of sovereign investors hinges on their commitment to transparency, accountability, and sustainable practices. Here's my conversation with Rod about Sovereign Investment Strategies 2024. Why do you do this report, and what can we learn from sovereign investors?
Thank you, Julia, for the opportunity to come and chat. We see the sovereign community, both central banks, sovereign wealth funds, and big state pension funds, as a very important institutional investor class, and have been delighted to follow it now for 12 years. So we see it as very much a unique piece of research that Invesco has created, and we feel that because of the overall total size of the segment, it is very worthwhile us continuing to follow that. And we know that our sovereign clients and prospects globally very much enjoy getting the research, so being able to come to a report like ours is a useful source of information for them.
Please tell us, what are the favorite investment sectors right now, and what is the difference of the investment strategy of these sovereign funds or sovereign investors 24? Are they more mitigate risk or size opportunities?
These are very long-term investors, so they're able to take advantage of market movements and invest for the long term and have the ability to take that illiquidity premium that sometimes arises from long-term investments. Mm-hmm. I think what we saw in this report versus the previous year is that it was refreshing that everything had returned to normal, if you like, and that the negative returns we'd seen in the 23 report were not seen in the 24 report. So everything had positive returns across the segment, and I think that's a very key comment to look at. What we did notice slightly was that the other thing we track quite a lot is the time horizon of investments for the sovereigns, and that was down slightly this year. We think driven by greater competition for good private equity deals. But I think to answer your other question about what they were doing, is we'd seen them start to shorten duration risk, looking at emerging markets as areas of opportunity, and I think beginning to sort of reshape the portfolios, increasing allocations to equities.
What's really interesting for me is that they shift into emerging markets investments like India. Is this more the Eastern sovereign funds or also the Western ones? And how does it come together, risk management and mitigate risk, and on the other hand, looking for emerging market investments?
If we look at emerging markets generally, over half of the sovereign funds were looking to the attractiveness of emerging markets. The allocations between Asia and the West were slightly different. it was 50% of the sovereigns in Asia and 36% in the West. So I think that reflects a recognition of being closer to the markets, perhaps some greater understandings. But I think what we'd also started to note is a greater discernment by the sovereign funds in terms of types of emerging markets. So not everything being grouped together as one homogeneous block. Beginning to separate out and have separate allocations for China, reflecting, China is probably a third of the emerging market index. So recognizing its importance and saying, okay, I want a separate allocation to China, and then being able to tilt the rest of the emerging market portfolio in the direction of expected growth, whether that's India, whether that's Indonesia or South Korea. India's, I think, an attractive market, considerable opportunities there, rising middle class, a greater expenditure, infrastructure opportunities. And from a sort of sectoral perspective, looking at, people have often sort of said, is it China or India? Well, actually, it's both. But currently, I think there's a perception that India, English language-based legal system, so from an overall attractiveness of that market, India has for the second year proven to be of great interest to the sovereign investors, and a number of the big sovereign funds in the Gulf. India's a short hop. There's a lot of intra-Gulf Indian trade and business, so they're very familiar with that part of the world. So a number of the funds, and also the funds from Southeast Asia, have been putting money into India.
And you said they are also keen on private equity. Why this? Do they have the same problem like Warren Buffett, that they are investing so much that they are trying to invest beside the stock exchange?
I think when looking at the emerging markets, we've also seen interest in emerging market debt. So, and just to give you a couple of comments there, 88% of sovereign wealth funds, and that's even higher in the West, are looking at emerging market debt as an area of great interest. And I think, in some of this, and sometimes it's the debt market, because in some cases the equity markets can be maybe slightly smaller. The free float of shares available for foreign investors may be limited, etc. And to your other comment about private credit, private credit has traditionally been a developed market product, but increasingly beginning to see some interest in private credit, again, in some of the emerging markets. And over half of the respondents thought that opportunity for private credit in emerging markets was equal or greater than that in the developed markets.
And what is financed with this private credit? Infrastructure, real estate?
Private credit is a non-market arrangement between a lender and the borrower. So it's not listed debt in terms of bonds. The growth of that really started, I guess, probably 12, 15 years ago with the financial crisis and the changing rules and regulations on bank lending. Created an opportunity for non-bank institutions to provide credit to smaller middle market companies, for example. One of the sovereign funds in the Gulf, a private capital entity based in the UK, they're buying a company called Hargreaves Lansdown, which is a very large UK sort of financial intermediary and manager, and a number of, there was a large sort of senior secured debt arrangement to help finance that. So that's, again, where there's a sort of club of lenders that are not banks, that are providing typically, in most private credit, is senior secured debt.
So these don't have to be public lenders. This could be, as you said, for example, intermediate financials.
You'll find asset managers providing some of the funding for that, etc. Yes.
You said that the sovereigns, citing your report, is using AI for their investment process. Since they have so much billions to invest, couldn't this influence the markets and lead to more volatility?
I don't think so. I think, and this is the first year we've looked at AI in this sort of lens. And we had noticed, in the past, sovereigns looking at, the blockchain infrastructure and trying to estimate how the changing financial infrastructure might impact their operations, et cetera. But this year, what we've seen is a number of the sovereigns beginning to start looking, and central banks, looking at AI for better decision-making, better risk-making programs, so leading to better and faster decision-making. We've also seen them invest a little bit in the sort of broader financial infrastructure, but they're very sophisticated investors with strategic asset allocation and tactical asset allocation policies and procedures. And they're certainly not a class of investor that would rush into any new type of investment. I'm not aware if many, if any, sovereign investors, for example, have invested in Bitcoin. So they're not necessarily trendsetters, but very methodical, very sophisticated investors, and able to take that illiquidity premium and try out small pieces of new areas in the market, but they're never going to be the ones to rush in. They're a bit like an oil tanker. They're very good at going in one direction, and it takes a while for them to tilt and change.
Would you say they are more a defensive investor, or how do they balancing defensive and opportunistic strategies?
I think it depends on their risk appetite, particularly. I'll say a lot of sovereigns have traditionally been fairly risk averse when it comes to looking at investments, and I think when we talk about the defensive versus opportunistic, I think on the opportunistic side, they may be looking at perhaps more high yield parts of the market. It'll depend on how comfortable and able they are to assess the risks internally, investor themselves. I think if they're able to have a team internally, they're able to look at more complex, challenging segments and enable them to be more opportunistic. But as you pointed out, if we look at the private allocations over the next year, over a third were looking for more opportunistic. So opportunistic is probably best to look at it as more risk seeking, and a relatively small number were looking to be sort of more risk averse in their investment approach to this asset category. So, and the opportunistic area, this is the emerging market, that they are more weighted in the emerging markets, or is it the private credit or private equity they are going more into? It could be a combination of all of those. So it could be looking at private credit in the emerging markets. It could be taking distressed debt, maybe a special situations fund, and really more high yield segments of that market. The market turmoil may create opportunities for them to, as I said, take distressed debt opportunities, special situations funds able to look at fallen angels and being able to invest in those. And again, with their long-term horizons, they're able to do that relatively easily, but within the strict confines of their overall sort of asset allocation structures. And if they take more risk and they have this long-term horizon, what's their idea of inflation then? I think it was interesting. In last year's report, inflation was considered the number one risk, with geopolitical risk number two. This year it's flipped, and both in the short term and longer term, the feeling is that geopolitical risk is higher, and inflation risk is a short-term risk. So we've begun to see rates slowly begin to edge downwards. There's a general view from the sovereign community, and the statistics are in the report, that inflation will remain a concern and above the targets, but I think there's a general view that interest rates and yields will remain in the sort of mid-single digits going forward. Mm-hmm. So I think some of the uncertainty around that has been removed.
If we stay at the global financial and economic outlook, does it differ from private investors? Do they have other opportunities or risks on their radar than private investors?
I think sovereign investors are very similar to other large institutional investors, very, very similar indeed. We break down in our survey the types of sovereign investors into four categories, which are investment sovereigns, which are the very traditional sovereign wealth funds, development sovereigns, which are the newer type of sovereign funds that have often been set up by governments to reorient the economy, develop a certain sector. Then we have liquidity sovereigns, which are very much at the shorter end of the curve and are charged with maintaining a pool of liquidity for emergency needs by the government. So those three typically don't have a prescribed liability structure on the other side, mm-hmm. whereas we call them liability sovereigns, and they are in fact the big state pension funds. They are the ones that have a liability structure that they're needing to match against. But again, they are the ones that are looking for perhaps the most yield mm-hmm. in order to fund those pension commitments. So I think sovereign funds and other large institutional investors act very similarly.
And do you think that the pension funds get more power, or which one grow most?
I think that depends very much on their risk return profiles and what their development objectives are. So if, for example, you have a development sovereign which is charged with reporting and trying to develop sectors of the economy, then they may have a slightly different return structure. And if you just to give you an example, just in the current report, the investment sovereigns had a return structure of just under 10% for the investment sovereigns. Development sovereigns, again, very similar, but liability sovereigns were lower, and the returns for liquidity sovereigns were very low because they would typically be, let's say, at the shorter end of the curve. Mm-hmm. And there's an average return across all that bucket of sovereign investors of 7.2% last year, and in the previous year that was minus 3.5%. So a very big rebound indeed.
In your current report, you also say that the sovereign wealth funds in their long-term asset allocation are more cautious about highly leveraged and growth-oriented investments due to uncertain borrowing costs. What can the investor learn from this?
I think the investor from that can learn from looking at the economics of a particular transaction, making sure that the capital structure is sound and not over-reliant on too much debt. Mm-hmm. And I think what the sovereign funds were looking at here, and we've, as I said when we started off, about the slight decline in the overall time horizon down to 10.8 years from 11.3. Some of that was driven by the sovereigns looking at the capital structures of some of the private equity deals, the congestion in the market for good quality deals. So I think the average investor it pays to look at the economics of the underlying transaction, and in a rising rate environment, which does seem to be beginning to stabilize, but in a rising rate environment, too much over-reliance on debt was causing perhaps some of the sovereign funds to be a little bit more selective in the transactions they pursued. And this is obviously coming after a decade of very low to negative rate.
How can I copy the investment strategy of sovereigns as a private investor, and how do you follow the sandals of sovereign wealth funds?
The Norwegians have been able to have adopted very much a market strategy of a large, sort of largely index approach. So they have replicated. Or look to replicate the market index in the equity markets. They have a real estate portfolio as well. So they're investing in real estate, equities, and fixed income. The lesson there would be to look at the index approach that the Norwegians have taken. If you were looking to try and replicate that, some sovereign funds have an element of sort of index replication, and as well as that, will then have a strategy of more actively managing certain asset classes to enhance returns.
And is there any fund you really admire the strategy, or you try to copy?
I think they're all very different. They've all been set up for different reasons. Some are based on the traditional sort of investment sovereigns. They're all based on either the export of hydrocarbons or the export of minerals. It's the world price of those that drives the flows that are available for investments for them. So those traditional big investment sovereigns will be typically creating a reserve fund for when the oil revenues are declining, or the export earnings of certain minerals and materials are declining. But I think generally looking at sort of good governance across the board rules, they've all the big sovereign funds have signed up to the Santiago Principles, and that determines, investments are made on the basis of the investment, not politics. They've all agreed standards of disclosure. So I think looking at the funds that are set up with those principles in mind are important. So I think looking at their structure there is important. Some of the newer development sovereigns have been set up with a particular development goal in mind for the national economy. If you look at the Public Investment Fund in Saudi Arabia, that's been very clearly charged with changing the economic landscape in Saudi Arabia away from reliance on hydrocarbons. You've got an infrastructure fund set up in India to look at promoting investment into Indian infrastructure. So it's very hard to pick one and say, this is the best. They've all got different development goals and origins and governance. But I think looking at something like the International Forum of Sovereign Wealth Funds, which is the sort of umbrella grouping for that segment, being members of that, adopting the Santiago Principles, creates the right governance and environment for the sovereign wealth community. And they're a large provider of capital to thrive and continue to grow, both in terms of investment in recipient countries, as well as creating a return for the governments and a portfolio for the future.
The sovereigns are modeling their portfolios against global climate goals. That would mean that investing in green energy would be a good idea because they are fueled also by the sovereigns and also the infrastructure area, right?
Yes, so I think what we've started to see, and we've followed this for a number of years, and it's moved from being a sort of ESG question on the periphery to now being very front and center. 81% of sovereigns are using ESG considerations when they look to pick a manager. They are looking, 61% of sovereigns have invested or have incorporated climate risk into their investment process. And I think that's very important going forward. So I think there's a recognition that climate risk is present and a clear risk to their portfolios. We've started to see them, increasingly allocate investments to renewables, clean tech, green tech across the world, trying to drive this low carbon transition. Sovereign wealth funds, central banks beginning to look at how to have lower carbon targets for their investment portfolios.
Also in your report, you look at the central banks and their reserves, and you write that they are bolstering their reserves and diversifying them. What does this mean from the dollar, which has been the most important reserve? And what does this mean for gold, Bitcoin, or even Europe? And should a private investor also diversify in their cash reserves?
Yes, there's been a lot written about the demise of the dollar and the rise of alternative reserve currencies. Yeah. I think what we're seeing is a sort of polarization and a differing approach, and I think the weaponization of reserves has come to the fore recently, and I think that concerns a number of central banks, and that is behind the driver for a number of central banks to increase their allocations to gold and increase allocations to physical gold, not gold swaps, gold futures, gold ETFs, but really wanting to add to their physical gold reserves. And I think, about a third of the central banks told us that they had increased the gold in the last 3 years, and another third were planning to increase again over the next 3 years. The question of, if not the dollar, what else? And I think we've tracked the use of RMB, for example. The central banks closer to China in Asia believe, I think, that the RMB could be a true reserve currency in a shorter period of time than those central banks, further away from China. As a result of the conflict in Ukraine, we're seeing, alternative payment mechanisms be established. But I think there's a very nice quote in the report, which I thought summed it up quite nicely in terms of the dollar. And I think that was, it reflects that there really isn't an immediate threat to the dollar or an immediate alternative to the dollar. Yes, this was the one, and this came from a central bank in the West. The dollar may not be a comfortable haven, but it's the best haven we've got. So yeah, I don't think the dollar is going anywhere anytime soon, but central banks are looking, and as their sort of exports and the trade patterns change, they're beginning to hold perhaps more emerging market currencies in their overall reserves basket. But we're still talking of relatively small shifts in reserve composition. You might see a little bit more Australian dollar or Canadian dollar or yen or sterling, and perhaps some more yen or slight increases in RMB. But it's very much small movements around the edges. No big concerns and no big worries on the dollar for a while.
Okay. What is your main lesson learned of your 12th report of the Sovereign investors?
I think a couple of things stand out for me. One is the sort of resilience of the long-term investment model they've created. I was particularly pleased to see them, recognizing climate change and factoring that into their investment portfolios. And I think also an increasing willingness to embrace new technologies, and whether that's AI or generative AI. When we looked at it, even I think we checked here, 3 or 4 years ago, it was a relatively small number. That's now increasing. So if that helps create better decision-making and faster decision-making, then I think that's good for the sovereign community as a whole. So I think 3 things, yes. The increasing use of recognition that climate risk is to be brought into the portfolio, the use of AI to make better and faster decisions, and their ability to be good long-term partners and investors, and they remain a force for good in the overall capital markets.
So it's good from the investor point of view if a core investor of a company is a sovereign investor?
Yes, and I think you'll find that those sovereign investors are investing either through index funds or portfolios that are a US equity portfolio, global equity portfolio. They will have made, as a result of that, they will be holding corporate names in that portfolio. The overall portfolio still needs to perform, but I think in times of real stress, sovereign investors have stood prepared to invest in certain single stocks or to play a role in supporting institutions, or when certain institutions have been floated or demerged, then sovereign investors have played a role in the financing of those.
But what are you doing with the reports for yourself?
So we use the reports. We use it to discuss with central banks and sovereign wealth funds. We take them through the report, the findings of the report. And I say they view it as a valuable piece of research as to what the sovereign community is doing in general. Because until recently, there have not been that many forums for the sovereign community to come together. And they view this as a valuable piece of research.
And your report, is it just for journalists, or can I look it up as a private investor?
It's available on our website.
Thank you so much for your expertise and time, of course. And we are keen on the report number 13 then.
So are we. Thank you very much.
Alles Gesagte ist nur die persönliche Meinung von Julia Kistner und daher keine Anlageempfehlung und keine Rechts- und Steuerberatung. Für Verluste, die aufgrund von getroffenen Aussagen entstehen, übernimmt die Autorin Julia Kistner keine Haftung.